Ever wondered how Warren Buffett became one of the richest men in the world through value investing? It's a fascinating journey, one that hinges on the art of spotting diamonds in the rough. Value investing is a strategy that focuses on finding stocks that are undervalued by the market. It is not about quick wins or overnight success. Instead, it's about patience, discipline, and a keen eye for long-term wealth creation. This is the essence of value investing, a philosophy championed by investing greats like Benjamin Graham and Warren Buffett. Over the course of this video, we will unravel the fundamentals of value investing, explore effective strategies, and share practical tips that can guide your own investing journey. From understanding intrinsic value to mastering the art of fundamental analysis, we've got you covered. So buckle up as we delve into the world of value investing. Value investing, a term you've probably heard, but what does it really mean? Well, at its core, value investing is an investment strategy that focuses on finding stocks that are undervalued. The idea is to buy these stocks at a lower price than their intrinsic or true value. This is the cornerstone of value investing, the belief that the stock market doesn't always reflect the true value of a company. But who came up with this ingenious strategy? The credit goes to Benjamin Graham, often hailed as the godfather of value investing. He emphasized the importance of intrinsic value, which is the estimated actual value of a company, as opposed to its current market price. The difference between the two is what Graham referred to as the margin of safety. The larger this margin, the safer the investment. Now you might be wondering, how do we determine the intrinsic value of a company? This is where fundamental analysis comes in, which we'll delve into more in the next scene. But for now, let's focus on one of the central concepts of value investing, the economic moat. An economic moat is a company's sustainable competitive advantage. It's what sets a company apart from its competitors and protects its long-term profits and market share from competing firms. Think about a castle surrounded by a moat. The wider the moat, the harder it is for enemies to attack. Similarly, a company with a wide economic moat is better equipped to fend off competitors and maintain its profitability. In essence, value investing is about finding quality companies that are undervalued by the market, companies with a wide economic moat and a larger margin of safety. It's about buying a dollar for 50 cents, if you will. With these key concepts, you're already on your way to understanding value investing. And remember, value investing isn't just a strategy, it's a philosophy, a mindset. It requires patience, discipline, and a keen eye for value. So, are you ready to start your value investing journey? The heart of value investing lies in fundamental analysis. This is where we dig deep to understand a company's true value, beyond what's reflected in its current market price. To begin, we have financial statements. These documents are like a company's report card, revealing its financial health. We have the income statement, showing the company's revenues and expenses over a period. Then there's the balance sheet, providing a snapshot of the company's assets, liabilities, and shareholders' equity at a specific point in time. Lastly, we have the cash flow statement, which tells us about a company's cash inflow and outflow during a period. These statements offer a wealth of information, but we need to know how to interpret it. That's where key ratios come into play. These metrics help us make sense of the numbers. For instance, the price-to-earnings ratio, or PE ratio, measures a company's current market price relative to its per-share earnings. A low PE ratio could suggest that the stock is undervalued, or it could signal that the market expects slow future earnings growth. Then we have the price-to-book ratio, which compares a company's market value to its book value. A low PB ratio could indicate that the stock is undervalued. However, it's crucial to compare these ratios within the same industry, as norms can vary. But fundamental analysis isn't just about numbers. Qualitative factors are equally important. We need to consider the quality of the company's management, industry trends, and the competitive landscape. A company with a strong management team, operating in a growing industry, and having a competitive edge is often a good bet. The trick is to combine both quantitative and qualitative analysis to paint a comprehensive picture of a company's worth. It's a bit like detective work, piecing together different clues to uncover the truth. Mastering fundamental analysis is a big step towards becoming a successful value investor. It's all about digging deep, asking the right questions, and making informed decisions based on your findings. Now that we've got the basics down, let's explore some strategies that can guide your value investing journey. First off, let's talk about contrarian investing. This strategy involves going against popular market trends. When everyone is buying, a contrarian investor is often selling, and vice versa. The rationale here is simple. When the market is overly optimistic about a stock, it's likely overpriced. On the flip side, when the market is overly pessimistic, there's a good chance it's undervalued. Next up, we have dividend investing. This strategy focuses on companies that regularly pay dividends. These dividends provide a steady stream of income, which can be particularly appealing during market downturns. Plus, companies that consistently pay dividends are often more stable, which means they're less likely to encounter financial trouble. Now, let's talk about the importance of a long-term perspective. Value investing isn't about making a quick buck. It's about finding companies that are undervalued and holding on to those investments until their true value is recognized by the market. This process can take years, even decades, but the potential returns make it worthwhile. Finally, let's look at some historical case studies. Take Warren Buffett, for instance. He's one of the world's most successful value investors. His strategy? Buying undervalued companies and holding on to them for the long haul. This approach has allowed him to amass a fortune and solidify his reputation as one of the world's greatest investors. But remember, these strategies aren't foolproof. They require patience, discipline, and a solid understanding of financial analysis. It's also important to stay adaptable. Market conditions change, and what works today may not work tomorrow. These strategies have proven successful for many value investors, like Warren Buffett. So, take the time to understand these strategies, apply them in your investing journey, and who knows, you could be the next Warren Buffett. Ready to put these strategies into practice? Here are some practical tips. Let's start with building a diversified portfolio. It's an essential part of any investment strategy, not just value investing. By spreading your investments across a variety of stocks, sectors, and asset classes, you can mitigate the risk associated with individual stocks or sectors underperforming. Now let's talk about market timing. It's a common misconception that successful investing requires perfect timing. However, even the most seasoned investors find it challenging to consistently predict market movements accurately. Instead, value investors should focus on identifying undervalued stocks and holding on to them for the long term. Patience is key here. Risk management is another crucial aspect of value investing. It involves understanding and mitigating the potential losses that could arise from your investments. This can be achieved by setting a stop-loss order, which automatically sells a stock when it reaches a certain price, thereby limiting your loss. Additionally, maintaining a margin of safety, which is the difference between a stock's intrinsic value and its market price, can provide a buffer against potential market downturns. Finally, arm yourself with the right resources and tools. Books like The Intelligent Investor by Benjamin Graham and Common Stocks and Uncommon Profits by Philip Fisher can provide valuable insights into value investing. Websites like Morningstar and Yahoo Finance offer a wealth of information, including financial statements and key metrics. Tools like discounted cash flow calculators can assist in determining a stock's intrinsic value. Remember, the key to successful value investing lies in patience and discipline. To recap, value investing is a proven strategy for long-term wealth creation. It's about finding those undervalued stocks, the hidden gems that the market has overlooked, and holding on to them for the long haul. Understanding the philosophy of value investing, the significance of intrinsic value versus market price, the margin of safety, and the concept of economic moats are all key to mastering this investment strategy. Fundamental analysis is your tool here. It's about dissecting a company's financial health through its financial statements, key ratios, and qualitative factors. And don't forget, a contrarian mindset, a focus on dividends, and a long-term perspective often go hand in hand with successful value investing. Remember, diversification, patience, risk management, and emotional discipline all play crucial roles in your investment journey. So, why not start applying these principles today? If you found this video helpful, don't forget to comment, ask questions, and share your experiences. And of course,